Yes.
All right, cool. So now we are aligned with the fundamentals that when do I have a liability? I have a liability if I've got a contract to deliver cash and I cannot avoid paying cash. How do I know I cannot avoid paying cash? Because one, the payments have to be made at a fixed determinable date. Or two, the payments have to be made, but I don't have the discretion to avoid paying them. Only the what? Only the holder can instruct me not to pay them. So that gives rise to an obligation. And if I have the right to avoid paying, it means I've got equity. Okay, done. Then now I could also have a situation where now I have what? Where now I have to pay my obligation using my own equity instruments. And we then said that the test is simple there. I ask whether the number of shares that I have to deliver, are they fixed or are they variable? And if they are fixed, it's not a liability. If they are variable, it is a what? It is a financial liability. So that is where we are so far. Okay. So hoping that we are aligned. So let me go back to my Excel. So now I want to introduce another aspect. What happens when I've got a contract that can be settled using either cash or using either equity, and someone has to choose? So let's start. So let's make an example of this. So we're going to break it down together. So we have a debenture issued by company A in exchange for what? In exchange for proceeds of 2 million rands. The terms, let me put a number, 10,000 debentures issued by company A. Sure. Then the debentures, the terms provide for what? For coupon payments at a rate of 8% per annum from what? From in arrears. At the end of 5 years, the debentures will mature, and at maturity, the debentures may be converted into ordinary shares based on a what? On an exercise price of 50 Rand per ordinary share. If not converted, the debentures will be settled in cash at a premium of 10% to the par value. So this is the par value of this debenture. So we've got this right here. So now let's understand the terms. So you are company A and I am the investor. You needed 2 million and then you gave me these debentures. Then I was very excited and I then said, what? Thank you very much. Sure. Then we look at the terms. And in the terms, you're saying for the right that I received by entering into this contract with you is such that I will then be paid 8% per annum. After 5 years, I can either get shares or I can either get what? I can either get I can either get my money back at a premium of what? Of 10%. Then you then said this will be at what? At the holder's discretion. Remember, quickly just to go back, the holder is the one that gave the money and the one who needs to be paid back at a later point. The one who received the money is the one that will be the issuer of the instrument. So this is the scenario. Everybody clear with the terms? Any question with the terms? Because I just want to make sure we are aligned. Was that an end? Okay, all good, okay. All right, no question. So we are happy with the terms. So now how do we deal with this? So then the standard says that if you get a very muddy contract, you need to separate all its components. You as the issuer, you gave someone, in this case, the holder, a couple of things that they never had before. So you gave them rights. Each and every right need to be assessed independently to see if it gives rise to what? If it gives rise to what? To equity, financial instrument, or otherwise both of these. So let's just be clear about the position of the holder. When immediately before this transaction, the only thing that the holder had was the 2 million in their bank account. So now they've given that 2 million. I said your company, I've now given the 2 million to you. But now what am I walking away with? I am walking away with a piece of paper with a bunch of promises, terms, and conditions. Now, what rights did I receive? So let's talk about my right. I now have what? The right, or rather, let's talk about you, because it says from the perspective of the issuer. So let's talk about you. You now have a number of obligations that you've made to me. Obligation number one, you are what? You are going to what? Company A is obliged to pay interest. They never had this before. Then number two, company A has got obligation number two, but obligation number two looks a little bit tricky because it's got contingencies or options. So we are saying there will be therefore an obligation 2.1, because remember, I don't know what the holder will want from me. So if the holder elects to convert the debentures into shares, that is, I've got what? I've got an obligation 2.1 to do what? To deliver equity instruments to them. Do you agree?
Yes, I do.
Then I also have obligation 2.2, because remember that the holder is the one with an option. The holder can come and say, can you deliver cash to me? Which is what? Which is that par value plus the 10% premium. So if the holder elects cash, then I have an obligation to do what? To deliver cash. But now I need to assess this obligation separately as to whether they give rise to an equity instrument or not. But do you see what is the first step? The first step is what? Is to identify all the components of the obligation that I've now taken over following this particular contract. Everybody clear about how we thought about this? Oh, any questions there?
Can I just ask, what is
Please.
the difference between a debenture and a bond or a loan?
So it's just a different piece of instruments. So it's like cash. If I say, do you have cash in your pocket? You will say yes, but it could be represented by a 10 rand note, 20 rand note, 30 rand note. All of them are mechanisms that companies use in order to raise funding. Why are they even different? Because they could be different rights that are attached to them. Let's say that I already have loans and they've got particular rights. So I don't want to confuse my other loan funders. I could say that I'm going to give this other party a debenture, and in this debenture, this will be the terms that they will have. And in some other basis, it could be for tax purposes and so on and so on. So all of them are just different instruments that are used in order to raise funding.
All right, thank you.
Sure, but substantially they achieve the same objective, vehicles to use. So all these other factors are what is at play.
Sir?
Yes, please.
I'm sorry, I don't know if I'm going off topic. May I please ask a question based on integration on a conceptual framework situation?
But wait, is it related to this? I don't want us to be.
Yes, no,
okay,
it is.
Okay, sure,
it
go for
is. It. If I'm confusing people, we can stop. It's fine. I can ask later because
sure.
I see that you've throughout the time you've been talking about financial asset and financial liability and equity and so on. So to me now, because obviously it's part of test 1, is conceptual framework that is triggered, which I was honored to ask. First of all, you see where you now talking how you've put obligation and so on. Can this be integrated conceptual framework? And if so, how can we approach it than we only focusing on an IS-32 situation or an IFRS 9 situation when we have to now focus on a conceptual framework definition if they ask it?
But wait, so what do you mean? Like, for instance, just maybe provide more light or guidance to your question. Like, in what way when you say linked?
Okay, since you earlier on you spoke about integration, which is possible, right? And I see that now that, okay, so you have helped now that you've already break it down into obligations and based on the issue and so on. So now to me, it has been ringing that if is it possible that can they ask? We see here now on this case study, okay, I see a financial asset, perfect. There's a high possibility they're going to ask me to classify this or to put it in journals or anything. But now they come up with this trick and say, you have done conceptual framework, there is obligation, which now you've already bring up. Can it be linked to it in a conceptual framework based on liability? And if so, is it possible to put out, can you help in putting it in application format?
So can it be done? Yes, but generally the expectations is that if a matter is particularly dealt with in a particular standard, it is not necessary to go back to the framework.
Okay.
We generally go to the framework where an issue is not so clearly dealt with by the respective standard. Because in this particular standard, this standard says you have a contract, and if this contract gives rise to an obligation or a liability, then you do this. So if then I can be clearly there, the expectation is that the examiners will be expecting to start there. But if now it's a weird contract such that we have to first go and assess whether there is a liability to begin with, then one could say, even before I go back to the framework, I have to start with IS 37 because it's a specific standard that deals with liability. But even if that is not so clear, I then have to go to the framework. So the framework is generally not the starting point. It is the starting point for unusual transactions. And not even a starting point. I think if you look at IS 8, it wants you to go to the specific standard. If the specific standard is not available, then go to the framework. If the framework is not helpful, go to the accounting manuals and other researches. So that's usually the hierarchy. You first deal with the specific standard dealing with an issue.
Okay.
And only if it's not well covered, you get out and you then go to the framework, which can clarify something and bring you back in to this standard or any other standard.
Okay, now I see
Yes.
the link. Thank you very much.
Sure. Okay. Yeah, okay, we were here, everybody was saying they're clear with the facts. Okay, so as I was saying, understanding the obligations arising from these is the first and most important thing. Then the next one is to classify all the obligations. It is to classify all of these obligations. So now let's start with number one. I am obliged to pay interest. And we said the test here is what? What is the test? What is the test? Who wants to deal with the component of interest? We said if there is a contractual obligation to pay cash, what is the test? Can
it be avoided? The cash avoidance test.
100%. So it is the cash avoidance test. So now let's apply. Can this interest be avoided? Based on the facts you have here. Can company A avoid paying the interest?
No, I don't think so.
Tell us. I know CTA students don't respond that way, Lusando. You don't say no and you keep quiet. Like, no. Let's respond like CTA students. How do you respond? Your mic is still off. Maybe, yeah, sure.
I'm not sure about the response, but yeah, I would say that because in the contract that it stipulates that on the terms that they must provide coupon payment at the rate of 8%. So it is stipulated in the contract. So I would say that they do have that obligation.
So which term in that contract that is proving to you that they cannot avoid paying? What gave it away? Because that's what you are trying to talk through. The test is, can we avoid paying? So which of these terms is getting you there?
Yeah, no, I'm not sure.
Okay, anyone wants to help Lutando?
Terms provided for component payment per annum in areas.
I will not give you a credit because it's like you are trying to trick the examiner. Which part is exactly proving to you that we cannot avoid paying the cash?
Hello.
Hi, Dimakat.
I think aid being at the holder's discretion.
There's no discretion when it comes to interest.
A coupon payment, sir.
When it comes.
Hello.
Oh, it's too many people at the same time now. Oh, okay, let's allow Dimakat to finish. Dimakat, are you saying? Are you done? Okay, seems she's gone. Right, who is on top of my list? Is it Pius?
Pius.
Pius, sorry. Thank you, Pius. Please go for it.
So I think it's because the terms of the contract provides that the coupon payment at a rate of 8% per annum.
No, but which term? Like you it's like you just copied and pasted, and as an examiner, I'm not sure whether you know which term out of what you've said is clarifying that.
I know, I don't know.
So remember what we said about the cash avoidance test. We said you cannot avoid paying if what is true. Sean, you're on top of my list. Go for it.
I think the coupon payment, we have an obligation to repay interest.
But we saw that, yeah.
I think would say an obligation exists because there is a determinable and fixed date of payment of interest.
No, but you've got the right principle, but your application is incorrect. So I'll still not give you a mark.
Okay, I would say there's a determinable, a fixed and a determinable interest, not date. There's a determinable and there's a fixed and a determinable interest to be paid, interest rate to be paid.
So you're changing the test now. So that's not the test. So it's not the amount that needs to be determinable. Yeah. Okay, let me take this next one. Is it Rwandile? Rwandile?
Hello. I think the main term there, which when you're dealing with the interest, to actually say the amount is actually the amount that is owed have to be paid. So the word there at the end of the sentence in arrears. So that means it must be paid.
But in areas, it doesn't stand on its own. Yes.
May I try, sir?
wait. I see there's some few hands that I need to just make sure I guess. No worries. So, Mabel, you're on top of the list because we have to remember the word. How do I know that I cannot avoid paying?
Hi, Rendani.
Hi.
First, I just want to find the clarity first. Are we talking about the interest or the retention?
Yeah, we have an obligation number one. Yes, obligation number one.
Okay, it's because of the contract that we've signed, because it's saying you have to pay the coupon payment of 8%.
But
that is
what if it says you have to
contractual obligation?
Huh?
It's a contractual obligation.
Yeah, but why? Because remember, let's go back to that example that was said to say, you will pay, but I will give you a notice. So the notice will come that, or I could say you will pay and you can decide otherwise. So we know that there's just more than it should say you should pay. We have to consider the core or the substance. That when someone takes you to court, they will have to rely on that provision.
Okay, can I just ask when
Yes.
they say it's going to be at the discretion of the holder, are we talking about the reason why I'm saying it's the obligation they have to pay is because it's at the discretion of the holder. So if ever it's at the discretion of the holder, they're not going to avoid to pay.
I don't know. So let me just add this to clarify. So here, remember that we're saying that it may be converted, and if not converted, so I'm saying this selection or option of selection, because this is the only thing that can be selected here. Right?
Yes.
So the conversion may happen or may not happen. So how will I know how it's going to happen? It's because the holder has the discretion with regards to what will happen.
Okay, so remember, if ever it was the issuer who have the discretion, so they were going to avoid to pay the cash. But in this case, it's because of the holder. The holder will need their cash back. So it means that.
But it sounds like you are on obligation number 2, because we are still on obligation number 1, which is provided for line number 2 here.
Oh, for first obligation, I'll say it's because of the contractual obligation. I'll stick to that. So it's a contractual obligation. So this is what we've signed for, to say we're gonna pay the interest.
But how do you know you can avoid it or not?
I'm not sure about that. I was going to stick to the last one to say it's at the holder's discretion. So I don't know if ever we have to separate the two, the interest and then the interest and then the redemption.
No, because we are not. Yeah, and that's the first part I was saying, that we have to separate them. That's what the standard wants us because otherwise we will confuse ourselves, because they've got different terms. But you guys are not borrowing a lot. Do you still have retail clothing accounts, some Woolworth credits, and so on? Don't you get statements? Like, what's happening? Ndibo, please go for it.
Hi, Rendani. So again, in line number 2, they tell us that there's an 8% rate that we must pay on per annum, right? So we have been given a fixed date for payment of that liability or whatever it is. So we can actually say that there's a fixed, there's a fixed or determined date that we must pay that, yes.
And that's it. That's what you need to tell the examiner. So that's it. It's not the 8%. It's not the fact that I have to pay that is significant. It is the fact that they put per annum. If a bank ever forgets that, I'll pay them whenever I want. But if they say every month and then you have to pay, or every year you have to pay, then I know that they will actually send a reposition guys, or they will now issue a judgment against my name. But if I take to court and said, no, judge, I agree that I still have to pay, but they didn't say when. So I am acknowledging the debt, I will pay, but not this year, not next year, because the contract does not provide for that. So the key thing that the contractor provided for is a fixed determinable date, which is per annum in arrears. So it is very important. So that's what we need to write, to say that company A is contractually obliged to pay the interest at a fixed determinable at a fixed determinable date, which is on an annual basis. Whether it is in arrears or not, that is irrelevant at this point. What we want to take away is that we are contractually bound to pay the interest at fixed determinable dates. So therefore, company A cannot avoid making such interest payments, or you could say does not have any discretion with to paying the interest. That's it. That's it. They can't. The contract says you have to pay every year. That's what we are assessing. We're not assessing the amount. We are assessing the fact that there is a fixed determinable date. Then you say, therefore, the interest component is what? Is a financial liability. That's what examiners want from you. And if you were not getting the marks before, now you know why not. And you now know what we are looking for as examiners. We are very easy to please, guys. We want just the core stuff. And once you know it, just give it to us and collect the marks. Collect. It's all about that. It's all about that. Okay? Because the way you were putting it earlier on, it is tricky because now I'm saying that this candidate does not know the term that gives rise. It's like you just went there in the scenario and copied the entire thing. But you see, we didn't even talk about the 8%. We didn't talk about the areas because we are looking for a fixed determinable date. So we focus on that. That's it. Everybody clear? Is there something that one wants to confirm? I see a hand. Juliet?
Oh, no, sorry. It's a historical hand. I wanted to answer the previous question you had asked. Sorry.
Okay. Sure. No worries.
Thank
No
you.
worries. Hey, everybody good here? Okay. No other question. Now let's move to obligation 2. But obligation 2, it's got what? It's got 2 components. So let's start with what? Let's start with obligation 2.2 or 2.1, it's fine. Let's start with obligation 2.1. So obligation 2.1, now who can tell me, will this give rise to equity or will this give rise to a financial liability? Who wants to give it a shot? So let me put back the facts again. So who wants to give it a shot? These are the facts. So we are now zooming into obligation 2.1. When now the holder has decided to exercise their option and they've told us that we need to deliver shares to them. So if they do that, do we then have a financial liability or do we have an equity instrument? What do you think? So Demakatso is saying we've got a financial liability. Why? The issuer, which is company A, have to settle the obligation with fixed own equity instruments. Who agrees or disagrees with Demakatso's point? So you can just say, I'm aligned, Sean, please.
It's Sean. So I think we are issuing a fixed number, right, of our own shares for a fixed amount. So wouldn't that be an equity?
Agreed. Oh, I see Demakatso corrected herself as well.
Okay.
Yes, agreed. Everyone on that boat. So now we are saying that in terms of what? The terms provide for a fixed number of shares. But let's see, how did we know again that's fixed number of shares? Yeah, because now you're applying, because so far your statement had suggested as if it was obvious, but nowhere did they say the shares are fixed. Now, prove to the examiner that the number of shares is fixed. How did you get to decide or to conclude that the number of shares is fixed? So I need the because. Because what? Because what? Demakatso or Sean, do you want to clarify how did you get fixed? or anyone to help? Yes.
Can try. Oh, sorry.
Who's going first? Yes, is it you or is it the war?
Let me come in. I think it's because the share price is fixed. And already the amount that we would be owing will be fixed, therefore the shares will become fixed.
Exactly. So that's it. Because the conversion price is what is fixed at 50 Rand, and the capital amount is fixed at the par value. Therefore, yeah, because yes, which is how much? 2 million divided by 50 Rand, and that will be the fixed number of shares. Okay, therefore, this component will be an equity instrument. So notice what I'm doing here, because I'm going to talk about it to say, again, what do we love as examiners? So as examiners, we love for you to show us that you understand the principle and you can apply it. And we also love the fact that once you've decided that the principle is applicable and you can apply it, what does it mean? So if we really love this, how do we then award you? We're going to give you 1 mark for applying with reason. And we're going to give you 1 mark for concluding, because for you to know that if this is the outcome, then this will be the premises. Then we have what? Then we have to award you credit for that. So we love that. And we are therefore saying, for just doing this, it's 4 marks. And the discipline that we'll also need to implement here, maybe I need to do it so that you then get to learn how we look for this discipline. So the company is contractual because so I'm going to do this to just entrench the thinking. So from an APC perspective, my candidates know that if I don't see because, they are unlikely going to get a credit. Because at this point, when you become a professional, you're going to have a lot of disagreements. So in order to really get people to your side, just give them a basis of how you're thinking about it. It also opens up an opportunity for you to learn, because you could then say that this is how I got there, and someone could say, oh no, I see how you're getting there and this is not appropriate because, and now you are learning. So always challenge yourself to say every time, put a because. Okay, now we are there. Let's deal with obligation 2.1. 2.1, if the holder elects cash, then what do we have? Do we have a financial liability or not? Sean? Old end or new end?
Oh, sorry, it was trying to
sure.
think on that.
Now, let's talk. Obligation 2.2. What do you think this is? If the holder now says, I don't want your shares, your company has been doing poorly, just give me my cash and I'll walk away.
Can I take a stab at it, Randani?
Please.
I'd say it's a liability. So we have an obligation to deliver cash par value plus 10% premium. So I think because of the 10% premium, I'd like to believe that it's something that is outside of control of the issuer. So as a result, we can conclude that it's a liability.
Okay, but let's go back, Sean. Why are you only focusing on the premium? What about the other par value part?
I think my thinking was
yes.
The par value was that the prices basically will still stay the same in quotation mark 50 rand, to say that, okay, it will be at 50 rand. However, there's this condition plus 10% premium.
And maybe let me clarify the facts here. Remember that it's either two things. The holder can come and say that you owe me 2 million, and I like the performance of your company, and your share is actually currently 70 rand. And when I convert, you are essentially selling a share to me for 50 rand. So here is my 2 million. Give me shares at a price of 50 rand. So that is obligation 2.1. So it's separate. Then obligation 2.2, I went out and looked at the stock market before I gave you a call. Then I realized that what? I realized that, oh, wait, your share price is 20 rand. Oh, you are selling it to me for 50. I don't want your share. So I'm going to drop my email and say that for the 2 million that you owe me, I know you're going to add a 10% premium, so it's going to be 2.2. Can you just transfer 2.2 into my account? So now we are saying that if we receive that email, what does that give rise to? So we are talking about that option that the holder has now made. They've told us they want 2.2 from us. So what does it represent, that option that the holder has? Does it represent a liability, or does it represent an equity instrument to us?
Okay, I think somebody can take a stab. I'm trying to think about it.
Sure, fair enough. Okay, cool. Anyone wants to help? Devo?
Let me give it a shot. So when we started, we read on the accounting standards, what is it, paragraph 11, I think, A, that defines a contractual obligation, which is an obligation to deliver cash to another entity. So in this instance, but it doesn't tell us the terms or anything like that. It just says to deliver cash to another person. So according to that definition, we would say that this is a financial liability. Just looking at it like that.
But one more. You know, I always want more. Like, so yeah, and we align on the definition, but what is it in the facts that prove to you that there is indeed this contractual obligation? So we said whenever you've got a contractual obligation to deliver cash, what is the test?
Okay, so there is the date, the fixed determinable date,
which is
that when the cash should be paid. So in this instance, we say at the end of the, what do you call it, the date that we have, the term, the person can choose to either, or the holder can elect to receive cash of 2 million plus 10%. So in this instance, they are actually exercising that option, which was predetermined in the contract, which we would then deem it to be a fixed date at the end of the term.
But it sounds like you're mixing the principles now. There are two to do the cash avoidance test. We said the first one is what? Is the predetermined date, and we said the second one is what?
Yes.
Yes. What was the second one to prove the cash avoidance test?
A fixed or determinable date of payment.
Then the second test in that, because there are two of them. We said the other one is what?
So you said if we cannot avoid to pay cash, right? That was the.
Yeah, but we then said we check it in one of two. We check it in one of two ways. Firstly, you cannot avoid if you are required to pay at some dates, or or what?
Yeah, I can't remember. I can't remember. Sorry.
Yeah. Sorry. Pairs. You. Oh, pairs. Are you there? Oh, okay. Benice, yes. What did we say secondly?
Before to apply properly, can you please go to the not the scenario, please?
I'm not seeing the scenario.
No.
What is happening?
Maybe it's my side.
Should I share again? Is the scenario gone?
Yes, it's variable, but mostly what I'm seeing on my screen is obligation 2.
Sorry.
Yes.
Sorry. In my mind, I'm seeing Excel. Sure.
Okay, let me try. I said we said it's a liability because as we use the contractual, she spoke about, let me recap, sorry. She already spoke about the cash avoidance test, right?
She didn't, so you can start them.
Okay, I'm not good at application. Okay, I will say that it's a liability because they have it's a liability if it is if the holder makes a decision of being paid in cash as it is not avoidable to pay. Okay, sorry, it's not avoidable to pay in cash because that if he pays the 10% in premium, it will be on the maturity date, which that is the terminal date. Sorry for mixing up the sentence.
But you're still sounding as we are saying and applying the test that she's applying.
Sorry, sir.
Yes.
I'm going to take you back. You mentioned the cash avoidance test that we've only determined the fixed determinable date.
Yeah.
And I think I missed the second one. That's where I'm getting stuck to respond because I'm thinking the second point on the cash avoidance test maybe is the one that will assist me in my thinking process so that I don't confuse myself. I actually got the one. So when you say there's a second one, I think I missed it during the class.
Okay. Amkela was the one asking about it. Amkela, you the one who asked about it. Do you remember it?
Are you picking on me?
It was your question, so are you picking on me?
Let me try and answer the question rather, and we will see. Okay, I think I will start with whether an obligation exists.
Yeah.
And I will say an obligation exists because an amount of cash, I don't know what was that case again, going down the obligation 2.2.
Yeah.
Okay, I would say an obligation exists because an amount of the par value plus a 10% premium will be paid on a determinable fixed date, which is the last day of, I don't know what is the last day, but the last day of this, I think it's 5 years or something, in 5 years' time.
Yeah.
And then the second part, I will speak about the cash avoidance test. And I would say that it is unavoidable for company A to not pay the amount as the terms. Can I say the terms lie with the holder?
The option lies with the holder.
The option lies with the holder. Yes.
Yes. And we said that is the second part of the cash avoidance test. So thank you very much. So just to recap, it's either one, there is a fixed determinable date in the contract, or it is not there because it may or may not happen. So it's not fixed. It may or may not happen. Then if it may or may not happen, then you then say, who can determine it? It is the holder who can therefore say, I want my money, and by doing that, determine it. So it's either the date is provided or this option is with the holder of the instrument. So in this case, you will then say that what? Company A cannot avoid paying cash if the holder exercises the option. They can't. Therefore, it is contractually obliged to what? To pay cash. So that's the trick. That in this particular case, I am saying that, do I have a liability? But this liability may exist or not exist. But then the standard says, if I don't have the option to decide, and someone else has the option, then we have the what? We have the obligation. So the key thing is who holds the key to exercising this option. If it is us, then there's no liability. If it is the holder, then a liability exists. Does that make sense?
Yes, is that all in paragraph 11 on the definition of the financial liability, sir?
No. So it's when they expand it further. So paragraph. So if you go to 17, it's when they expand it. Yeah, 17. But the one that talks about the test is paragraph 19. Maybe if you want to read for us when you get to 19. Paragraph 19. Yeah.
I didn't even highlight it, hey? Can I read the whole of paragraph 19? It's shocking. 17 is highlighted and 18, but 19, not even anything. Okay, it says, if an entity does not make an unconditional right to avoid delivering cash or another financial asset to settle a contractual obligation, the obligation meets the definition of a financial liability.
So sorry, if so the except is out of our syllabus, so you can highlight up to that point.
Okay.
So the except part we don't need to know. Yes.
Wonderful.
Sure.
Okay. Must I continue to A and B?
Yeah.
All right. A says a restriction on the ability of the entity to satisfy a contractual obligation, such as lack of access to foreign currency or the need to obtain approval for payment from a regulatory authority, does not negate the entity's contractual obligation or the holder's contractual right under the instrument.
Sorry, and let's apply that. So this will be mostly applicable to our ZIM candidates, because in ZIM we've heard about foreign currency problems, where then they are saying that, but there's lack of enough currencies, dollars, rands, in order to discharge my obligation. So you cannot go to someone and say, guys, I can't buy the currency, so I don't have the debt. So that's what A is saying. It's not enough to just say, because you are lacking access to currency, you don't have the obligation. You still have the obligation because you cannot avoid it. So that's what A is giving an example. So any restriction on the ability. So even the same way that you can say to the bank that, guys, I reversed the debit order this month because I didn't have money. The bank say, oh, it's fine. That means this date has passed. You are all good. Let's move to this. It doesn't happen. So the limitation of you not having cash won't cut it. Then B.
Okay. The contractual obligation that is conditional on a counterparty exercising its right to redeem is a financial liability because the entity does not have the unconditional right to avoid delivering cash or another financial asset.
Do you see that? So that's B right there. The one, because it says a contract obligation that is conditional on a counterparty, not us, on a counterparty exercising its right to redeem. And this company has now exercised its right to call its cash. So that is a financial liability because we cannot, or we don't have an unconditional right to avoid pay. So that's paragraph 19B, that is on obligation 2.2. Does that make sense? Is it clear now?
Yes, thank you, sir.
Sure. Everybody clear? So now we are saying that, maybe let me put this, so I'll share this with you. So I'm just gonna put paragraph IS 32, paragraph 19. Okay. So therefore, what is it? Therefore, this component is what? Is equity or financial liability.
The financial liability.
The financial liability.
Great.
So do you mind like zooming out a bit so that we can see the whole screen? I'm not sure if I'm the only one, but I'm not seeing them. Yeah, perfect. Thank you.
So then we have the overall obligation. So the classification of this instrument is such that we have equity instrument and the components, we have components. of equity instrument and what? And a financial liability. Therefore, this is what? Therefore, this is a compound instrument. So this is typically a 9 marks discussion question. Do you see how we got there? Do we see how we got them? Matume, please. Oh, okay. That was the end. Okay, agree with Demarcats on the chat. Yeah, you were aligned due to the holder having the discretion, 100%. That's a quicker way to get to where we are. Tuko Law says it is a compound financial present value. Yeah, so but remember that that is the conclusion that we have to reach based on the components. So you should never conclude that it's a compound instrument before you've dealt with all the components. Okay, but yeah, we aligned. So now we were clear. Okay. This was there was this kind of a sub question in the question. Okay. Did you enjoy it? Oh, well, they love this in ITC. So a number of questions in ITC, we've often seen this one. Great. Great, I love that. Hey, any further question before we wrap this up? Okay, so nothing. All right, then there are some legal nice exam technique things that I've left up to here, but I think for me, I always find these are the easier marks that you need to secure. And that then will conclude, or let's quickly, where is my slides? Let me quickly go back to my slides now. Where are my slides? Okay. So here, I just got a decision tree that is just summarizing some of the things we are talking about. So like, for instance, we ask ourselves, does settlement happen in equity or shares? It happens in shares. Then what's the question? Does the entity have a contractual obligation? If the answer is yes, they've got a financial liability. If the answer is no, is there an implied contractual obligation? So an implied contractual obligation is the following. I will do it. I will pay you your money back at the end of this month if I've already qualified as a CA. So that you and I have agreed on that. So maybe let's say you then agree and said, Renani, please borrow me back this money. Borrow me this money. It's 100,000. You then say that let's agree that I'll pay it to you. What do you call it? Provided that I'm a CA by the end of the month of the year. Then I'm sitting here and I'm saying that, but wait, being a CA requires that you complete CTA, you do ITC, you do APC, and the APC results even come out in Feb. So if you're not yet written the APC, how are you going to qualify as a CA at the end of the month? So there is an impossibility in the contract that we have signed. So if there is an impossibility, then essentially we're going to ignore that condition, and it will imply that therefore an obligation exists or does not exist. So they say that this happens when there's a condition that is very likely not to occur. And as a result, it will ignore or give rise to an obligation. So that's what the standard talks about, but we've never seen it in an exam. Then on the other side, is it a contract derivative? Then the number of equity instruments to be issued, are they fixed or are they variable? They are variable financial liability. They are fixed equity instrument. So that is how this decision tree actually works. So there are others, but fundamentally, the ones we discussed are the ones that you need in order to master this. Then what we are talking about here is that interest, dividends, losses, and gains, they follow the classification. What do I mean they follow the classification? If you have what? If you have a financial liability, then interest, dividends, losses, and gains, P&L. But if we have an equity instrument, interest, dividends, losses, and gains straight to the statement of changes in equity. So that is that principle that we saw at when they say the related classification of interest, dividends, losses, and gains. And in simple terms, they simply follow the what? The parent. Then we spoke about a compound financial instrument. And now, where are we? Let me see, 14, good. Sure. Any questions so far? Or can we now move to the liabilities? Because now we've got a liability, so now you might be saying, what do we do with it? I see it that your instrument has got some financial liabilities and it's got some equity, but I'm interested in the liability. What do I do with the liability? So let's now visit IFRS what? IFRS 9.